Good morning everyone, and welcome to your lecture on IAS 12 income tax. This is your last topic for the year. I'm sure you are all very excited about that. So just to give you a little bit of an idea of how the next day or two is going to work, today you will be watching this video where we will deal with all of the concepts relating to IAS 12 income tax, and in the video that is scheduled for tomorrow as per your daily schedule, that is where we will look at a class example. Let's get started. So first things first, what is income tax? Take a moment and think about what you understand income tax to be. Income tax, or tax, is levied on all of the income and profit that is received by a taxpayer. Now, a taxpayer comprises of individuals, companies, and trusts. So all of the parties, as you have learned in BEL 200. And income tax and tax is the main source of income for the government, and the government uses the tax that it receives from the people in order to build new infrastructure, build new roads, build new hospitals, build new public schools. So this is the main source of income that the government uses in order to provide infrastructure for the people. So how does income tax and tax affect accounting? Well, if we owe SARS money, we will have to make a payment to SARS, and this payment to SARS will result in an outflow of resources. That outflow of resources has accounting consequences, so we need to present and disclose this outflow of resources so that the users of our financial statements know exactly how much money was paid to SARS, how was this amount calculated, what does this payment represent. Now, when we look at presentation, the first place that you will generally see your income tax line item is in your statement of profit or loss and other comprehensive income. In our statement of profit or loss and other comprehensive income, we always have profit before tax, then we have income tax expense, and then profit before tax less your income tax expense gives you profit for the year. And it is that profit for the year that is transferred to retained earnings and forms part of the retained earnings closing balance in our statement of financial position. Now, the income tax line item will always appear after profit before tax in the statement of profit or loss and other comprehensive income. Now, how on earth do we determine the income tax expense as presented in the statement of profit or loss and other comprehensive income? Well, we need to take into account the current tax for the year. We need to take into account whether there was an under or over provision of tax in the previous year. And then we always need to take into account the deferred tax movement. Now, I'm sure you have heard of the terms current tax and when there is an under or over provision, but the concept of deferred tax will be new to you, and we will focus on that later in this lecture. So when we determine the income tax expense, we have to take into account current tax, any under or over provision of tax from the previous financial year or the previous year of assessment, and then your deferred tax movement. And importantly, income tax expense is deducted in order to get your profit for the year. If we then go and look at how the statement of financial position is affected by income tax, under the asset section, we know that we have non-current assets and current assets. Now, non-current assets are those assets that are not going to be converted into cash within 12 months, whereas current assets will be converted into cash within a 12-month period. Now, under non-current assets, you can have deferred tax assets. Once again, deferred tax will be looked at slightly later in today's lecture. And then you can have your current tax assets under current assets. Now, if you have a current tax asset, that means that you have overpaid SARS, and SARS actually owes you a portion of your tax back. So it is a current tax asset. If we then go and look at the liabilities section of the statement of financial position, once again, we have non-current liabilities and current liabilities. Non-current liabilities are those liabilities that we will settle in more than 12 months, and current liabilities are those liabilities that will be settled within the next 12 months. Now, once again, under non-current liabilities, we can have deferred tax liabilities, And once again, deferred tax will be looked at slightly later in the lecture. And under current liabilities, we can have current tax payable as a line item. And you will have current tax payable when you have when you owe SARS money. So that means that the tax assessment from SARS has come back and you owe them, for example, 90,000 Rand, but you have only made tax payments amounting to 85,000 Rand. You have paid too little and therefore you owe SARS additional tax. If we then go and look at the disclosure of income tax expense, we disclose income tax expense in a note to the financial statement. Now, in this note for income tax expense, we break down the total of the income tax expense for the year into the major components that make up the income tax expense. So those three main components that make up the income tax expense for a year would be your current tax, if you have an under or over provision in terms of your income tax paid in the previous year, and then your deferred tax movement. So the format of the note is very simple. It would be the name of the entity, notes for the year ended, income tax expense, and then you write there major components of income tax expense, and you now know that the three major components of income tax expense are current expense, an under or over provision in terms of the previous year of assessment, and then your deferred tax movement. We can now go and look at current tax. Now, what's very important to understand is the taxation treatment and the financial accounting treatment of current tax are not the same, all right? In BEL 200, you learn how to calculate taxable income, but in financial accounting, we don't go and calculate taxable income, we go and calculate accounting profit. But accounting profit is not the starting point for our current tax calculation. Taxable income is. So what's very important to note is that taxable income is not the same as accounting profit. And in order to get from accounting profit to taxable income, we are going to need to make some adjustments. And then once we have got taxable income, we can multiply the taxable income by the applicable tax rate, and that will then give us current tax for the specific year of assessment at which we are looking. So we said on the previous slide that taxable income and accounting profit are not the same, but in order to get your current tax, your taxable income needs to be calculated. So how on earth do we get taxable income from our accounting profit? Well, we always start with our profit before tax figure because we are going to calculate the tax and therefore we need to start with profit before tax. We will add back any non-deductible expenses. So an example of a non-deductible expense would be depreciation, all right? When you go and calculate taxable income as per BEL 200, you don't take depreciation into account. Depreciation is a non-deductible expense for income tax purposes. Now, the reason that we add it back is that in order to get to profit before tax, what did we do? We deducted depreciation. We now want to get rid of the effect of that depreciation, and in order to do that, we need to add it back. We then go and deduct any deductible allowances. So if we think back to that depreciation example, we know that the Income Tax Act does not allow us to deduct depreciation when determining our taxable income. But what do we get in relation to our assets? We receive a wear and tear allowance. So when we add back the depreciation, we are then getting rid of the accounting effect. And then we go and we deduct the wear and tear allowance, because wear and tear allowances is a deduction in terms of what you have learned in BEL 200. That then means that you are now bringing into account the tax effect. And then we go and we deduct any non-taxable income. So for example, dividends. Okay, so think about dividends. In tax, you know we include dividends in our gross income, but then the dividends get a local dividend exemption or a foreign dividend exemption. So in this case, we're more than likely looking at local dividends. So you would have included it in your taxable income, but then you take it out. So the net effect is 0. So that means we cannot have dividend income sitting in our amount for taxable income. But dividend income is sitting in profit before tax. And because it is an income, it would have been added. So in order to get rid of the effect of this dividend income, we then go and deduct it. By taking your profit before tax, adding your non-deductible expenses, deducting your allowances, and deducting your non-taxable income amounts, that then gives you taxable income. For the purposes of FRK 201, we will give you the amounts and the relevant tax rates, and you just need to know what to do with these amounts. Let's now take a look at an example. The required of this example asks us to calculate the taxable income and current tax. Company A has an accounting profit before tax of 250,000 Rand. Included in this amount is dividend income from South African companies amounting to 12,000 Rand, speeding fines amounting to 750 Rand, depreciation of 5,000 Rand, and the company would get a wear and tear allowance of 7,500 Rand. The company tax rate is 28%. Now, in order to get our taxable income or our taxable profit, we know that we need to start off with the accounting profit as given to us of 250,000 Rand, and then we have to adjust for non-deductible expenses, non-taxable incomes, and any other items. So we start off with our accounting profit of 250,000 Rand. We then know that included in that 250,000 Rand was dividend income of 12,000 Rand. Now that dividend income is non-taxable, so to get rid of the effect of the dividend income on the accounting profit, we have to deduct the 12,000 Rand. The next item that was included in that 250,000 Rand was speeding fines amounting to 750 Rand. Now speeding fines, that is a fine, you got it from taking part in illegal activities, and that is a prohibited deduction as per the Income Tax Act. So as it is a prohibited deduction, it cannot be deducted when calculating taxable income, and as a result, we need to add it back. Why do we need to add it back? Well, in order to get accounting profit, these fines were treated as expenses, so they were deducted in order to get the 250,000 Rand. To get rid of the effect, we now go and we add it back. The next item that we need to take a look at is depreciation. Now, the depreciation included in that 250,000 Rand amounted to 5,000 Rand. We know that depreciation is non-deductible, and therefore we need to add it back in order to get to taxable income. But in relation to those same assets that depreciation is written down on, we know that SARS allows us a wear and tear allowance. And that wear and tear allowance amount of 7,500 Rand was given to us and must therefore be deducted. That then gives us a taxable income or a taxable profit of 236,250 Rand. Now that is taxable income, so the first bit of the requirement has been complied with, and now we need to go and calculate the current tax. How do I get current tax? Well, I take my taxable income and I multiply it by the applicable tax rate. So we take our taxable income of 236,250 Rand and we multiply it by the company tax rate of 28%. That then gives us current tax of 66,150 Rand. On this slide, we look at the journal entry in relation to the current tax payable of 66,150 Rand, which was calculated on the previous slide. Now, we know that the current tax figure is 66,150 Rand. We were not told that that amount was paid to SARS immediately, so that means that we owe SARS that money. So automatically, we have a credit entry to current tax payable from the statement of financial position amounting to 66,150 Rand. Current tax payable would be presented as a current liability under your liabilities section in your statement of financial position. So we now have the credit entry of the general journal entry down. Now we need to go and figure out what the debit is. Earlier on in this lecture, we stated that one of the three major components of income tax expense is your current tax payable. So that then means that your contra account to your current tax payable would be your income tax expense. So the journal entry to account for the current tax for the year would be to debit your income tax expense in profit or loss and to credit current tax payable in your SFP with 66,150 Rand. We will now take a look at provisional tax payments. Now, in accordance with the Income Tax Act, we are required as a company to make a total of 3 provisional payments to SARS. Technically, you only need to make 2 provisional payments, and then the third payment is at your discretion. So the first payment needs to be made 6 months after the start of the financial year. The second payment will be made at reporting date, so at the end of the financial year. And then the third payment can be made 6 months after year end. Now that third payment is like a top-up payment. So with regards to the first and second provisional tax payment, we estimate the provisional tax that we are going to be paying by estimating our taxable income. With the third payment, we make this payment in order to settle the outstanding liability. So technically, you only really need to make this third payment if your first and second provisional payment are short of what your actual income tax assessment for the year is. So just that you can see this in practice, on that little timeline, that represents an 18-month period. That little X represents the year end. So you make a payment 6 months into your financial year, money flows out of your business, you actually make a physical payment to SARS. At year end, you make another payment to SARS. All right, once again, cash outflow. And then 6 months after year end, if your estimate is more than the provisional tax payments that you have made, you as a business will choose to make a third provisional tax payment. And once again, once you have made that third provisional tax payment, money flows out of your business and therefore you have an outflow of resources. Now, when we have a provisional tax payment, how do we account for this? What are the general journal entries that we need to pass? Well, we will debit current tax payable and we will credit bank. The easier part of that journal entry to understand is the bank leg. Because we are making a physical payment of cash, bank is decreasing, bank decreases on the credit side. Therefore, bank needs to be credited. And then our contra account is current tax payable. So we debit current tax payable, which also makes sense because you're decreasing your liability to SARS by making these provisional tax payments during the year. The whole point of making provisional tax payments throughout the year is so that at year end or a couple months later, when you actually physically receive your income tax assessment, you do not have to take a huge chunk of cash and pay it then and there because you've already paid some of your liability off. So we are decreasing our liability by making these provisional tax payments. If we pay too much in terms of our provisional tax payments, so our provisional tax payments exceeds our income tax assessment, we will then receive a tax refund. SARS will owe us money. But if we pay too little in terms of our provisional tax payments, then we will need to make further payments to SARS. Let's take a look at another example. The required of this example asks us to calculate the taxable income and current tax payable balance at the end of the year. Company A has an accounting profit before tax of 250,000 Rand. Included in this amount is dividend income from South African companies amounting to 12,000 Rand, speeding fines amounting to 750 Rand, depreciation of 5,000 Rand, and we are granted a wear and tear allowance of 7,500 Rand. The first provisional tax payment was made based on an estimated taxable income of 190,000 Rand for the year. Tax payable in terms of the assessment of tax is 69,000 Rand. The tax rate is 28%. Once again, our starting point is to calculate the current tax for the year, and in order to do that, we need to calculate taxable income. So we start off with our accounting profit of 250,000 Rand. We then go and we deduct our non-taxable dividend income, as that dividend income had been included to get that 250,000 Rand. We then go and add back our speeding fines of 750 Rand, as speeding fines represent prohibited deductions. We go and add back our non-deductible expenses in the form of depreciation, and we then go and take into account the wear and tear allowance that we would be allowed under Section 11E of the Income Tax Act. That then gives us taxable income of 236,250 Rand. In order to get the current tax, we take the taxable income and we multiply it by 28%. So if we take the 236,250 Rand and multiply it by 28%, that then gives us current tax payable of 66,150 Rand. We now need to go and work out what our provisional tax payments were, as we know that these provisional tax payments actually reduce our current tax payable. So the first provisional tax payment was based on a taxable income estimate of 190,000 Rand. Now that first provisional tax payment will be half of the total provisional tax payment. So if you take your estimate and you divide it by 2 and then multiply it by 28%, you then get the Rand value of the first provisional tax payment to be 26,600 Rand. We then go and work out what the second provisional tax payment is. Now the actual taxable income for the year was 236,250 Rand. We would use that actual taxable income that we calculated at the end of the financial year as our basis for the second provisional tax payment. So if we take that 236,250 Rand, we multiply it by 28%, that then gives us total tax payable of 66,510 Rand. If we go and deduct the first provisional tax payment from that 66,510 Rand, we then get that we would have made a second provisional tax payment of 39,550 Rand. So total provisional tax payments amount to 66,510 Rand, but the actual amount of income tax that we need to pay as per our income tax assessment amounts to 69,000 Rand. The difference between the 69,000 Rand and the 66,510 Rand is a 2,850 Rand under provision. Now that under provision means that we have not paid enough tax. We owe SARS this money. Now how do we show this in a journal entry? Well, because we underprovided for our tax for the year, that means that we owe SARS more money. So we credit our current tax payable in your statement of financial position with 2,850 Rand. Your contra account is your income tax expense, so we debit our income tax expense with 2,850 Rand. Why do we debit income tax expense? Well, our income tax expense should reflect what our income tax assessment for the year is. So we currently had an income tax expense of 66,000 Rand odd. We now need to add that 2,850 Rand in order to get a final income tax expense for the year, which is in line with the income tax assessment received from SARS of 69,000 Rand. Let's now look at another example. The required of this example is to calculate the taxable income and the current tax payable balance at the end of the year. Company A has an accounting profit before tax of 250,000 Rand. Included in this amount, we have dividend income from South African companies amounting to 12,000 Rand, speeding fines amounting to 750 Rand, depreciation amounting to 5,000 Rand, and a wear and tear allowance amounting to 7,500 Rand. The first provisional tax payment was made based on an estimated taxable income of 190,000 Rand for the year. Tax payable in terms of the assessment is 65,000 Rand, and the tax rate is 28%. Once again, our starting point is to calculate the current tax for the year, and in order to do that, we need to calculate taxable income. So we start off with our accounting profit of 250,000 Rand. We then go and we deduct our non-taxable dividend income, as that dividend income had been included to get that 250,000 Rand. We then go and add back our speeding fines of 750 Rand, as speeding fines represent prohibited deductions. We go and add back our non-deductible expenses in the form of depreciation, and we then go and take into account the wear and tear allowance that we would be allowed under Section 11E of the Income Tax Act. That then gives us taxable income of 236,250 Rand. In order to get the current tax, we take the taxable income and we multiply it by 28%. So if we take the 236,250 Rand and multiply it by 28%, that then gives us current tax payable of 66,150 Rand. So once again, we now need to go and calculate our provisional tax payments. The first provisional tax payment was paid 6 months into the financial year and would have been based on the estimate of taxable income for the year of 190,000 Rand. That means in order to get your first provisional tax payment, you take 190,000 Rand, divide it by 2 because you are going to make at least 2 provisional tax payments, and then you multiply by the company tax rate of 28%. That means your first provisional tax payment paid to SARS would amount to 26,600 Rand. We then need to go and calculate our second provisional tax payment. Now, the second provisional tax payment is made at year end. We now know what our actual taxable income is, and our actual taxable income is 236,250 Rand. If we go and multiply that by 28%, we get that we should have made total provisional tax payments amounting to 66,510 Rand. But we've only so far paid 26,600 Rand. That means that our second provisional tax payment needs to be the payment of the difference of 39,550 Rand. That means that during the year, we made total provisional tax payments of 66,510 Rand. However, the amount as per our tax assessment amounted to 65,000 Rand. That means we have over-provided for our tax. We now have an over-provision of the difference, which amounts to 1,150 Rand. Once again, how does this information convert into a journal entry that you can process through your general journal? Well, we have over-provided, okay? Therefore, that means that SARS owes us money, so we have to decrease the amount that we owe to SARS by debiting current tax payable with the 1,150, and we then credit our income tax expense with the 1,150 Rand. The next concept that we need to take a look at is the concept of deferred tax. Now, what's important to understand is that we may get deductions for accounting purposes now, but that does not necessarily mean that we will get the tax deduction for tax purposes now as well. We can get the deduction for accounting now, but we may only receive the tax consequences, the tax deduction, in the future. This exact opposite applies as well. We may get tax deductions now that we will only receive for accounting purposes in the future. And because there is a time delay between the accounting and the tax is deferred. If we have a deferred tax liability, that means that we will end up paying more tax in the future. If we have a deferred tax asset, that means that in the future we will receive a tax deduction. Now, for FRK 201 purposes, you are only required to understand how to account for the movement in a deferred tax balance from the beginning of the year to the end of year. You will not be asked to perform the deferred tax calculation in FRK 201. That is done in FRK 300. So you need to know how to account for the movement in deferred tax. Let's say, for example, we have a deferred tax liability. Now we know liabilities increase on the credit side, decrease on the debit side. So our opening balance in relation to a liability is sitting on the credit side. So we have an opening balance of our deferred tax liability of 85,000 Rand and a closing balance of 92,000 Rand. The difference between the 92,000 Rand and the 85,000 Rand is the movement in the deferred tax liability balance. Then you need to understand whether the difference, the movement, is a debit or credit movement. So if we have an opening balance of 85,000 Rand on the credit side, and all of a sudden we have a closing balance carried down of 92,000 on the debit side, which side did we do something to with that 7,000 Rand? We credited the deferred tax liability account with the 7,000 Rand. Because 85,000 Rand plus 7,000 Rand gives us that 92,000 Rand closing balance. So the difference is a 7,000 Rand credit. So when you now go and translate this and you go and you look at the journal entry that you would pass, We debit income tax expense with 7,000 Rand, and we credit deferred tax with 7,000 Rand. Now, why is income tax debited? Well, we know from earlier on in this lecture that one of your three main components of income tax is your deferred tax movement. We are now accounting for the movement, and the movement will either increase or decrease your income tax expense. So because we've credited deferred tax, that means that we have to debit our income tax expense. Let's now look at this from the perspective of having a deferred tax asset. We know that assets increase on the debit side, decrease on the credit side, so our opening balance in relation to an asset sits on the debit side. So let's say we have an opening balance of 85,000 Rand and a closing balance of 92,000 Rand. Once again, the difference equals the movement, and the difference between 92,000 Rand and 85,000 Rand is 7,000 Rand. If the opening balance is 85,000 Rand and the closing balance carried down is 92,000 Rand, did we debit or credit our deferred asset account with that 7,000 Rand? The answer is that we debited our deferred tax asset account because 85,000 Rand plus 7,000 Rand gives us 92,000 Rand. So that means our difference is a 7,000 Rand debit. If we now go and translate this into a journal entry, we would debit deferred tax with 7,000 Rand and credit our income tax expense with the same 7,000 Rand. Once again, why is income tax affected? Because one of the three major components of income tax is our deferred tax movement for the year. Please remember that at FRK 201 level, you are only required to be able to take into account the difference in the movement and how to record that. That then brings us to the end of this lecture of income tax. Please remember to go through your Introduction to IFRS chapter in relation to this section. It is not advised that you go and read through your IAS 12 yet, because that can be quite confusing. Because we are really only doing the basics at FRK 201 level.